There's a button, not a physical one, but a decision. A single administrative choice that can be made in under an hour. And when it gets flipped, your bank account doesn't work, your credit card declines, your paycheck doesn't arrive, businesses can't pay suppliers, hospitals can't order medicine. The entire circulatory system of money flowing invisibly through pipes you never see just stops. This isn't a cyber attack scenario. It's not a grid failure or some dystopian fiction. It's happened before, multiple times, and it could happen again tomorrow. The switch has a name, correspondent banking, and almost no one outside of finance knows it exists. Let's start with what should be a simple question. How does money actually move? You wire $5,000 to a friend across the country. You tap your card at a coffee shop. You pay your rent online. Money appears to teleport instantly from one account to another, but it doesn't teleport. It flows through a hidden network of banks, all talking to each other, all settling accounts in the background. And at the center of that network sits a very small number of very large banks that act as intermediaries for everyone else. These are called correspondent banks. They're the infrastructure, the highways, the switches. And when they close your access, you're not just cut off from one bank, you're cut off from the entire global financial system. Here's how it works. Let's say you have an account at a small regional bank in Ohio. That bank doesn't have a direct relationship with every other bank on earth. It can't. There are tens of thousands of banks globally. So instead, your small Ohio bank has an account at a larger bank, say JP Morgan Chase or Bank of America. That larger bank acts as a correspondent, a middleman. When you send money to someone at a bank in California or London or Tokyo, your small bank routes a transaction through its correspondent. The correspondent bank talks to other correspondent banks. They settle the payment, and the money arrives. You never see this happen. It's invisible, instant, until it isn't. Because here's the uncomfortable part. Correspondent banks have the power to simply stop serving you. They can close your bank's account with them, refuse to process transactions, cut the cord. And when they do, your bank and everyone who banks with it is suddenly stranded, cut off from the global system, unable to send or receive international payments, sometimes unable to process domestic ones. This is called de-risking, and it's happening more often than you think. Let's rewind to see how we got here. After 9/11, governments around the world got serious about tracking money, terrorist financing, money laundering, tax evasion, drug cartels. New regulations flooded the financial system. Banks were required to know their customers, to monitor transactions, to report suspicious activity. If a bank failed to comply, the penalties were brutal. Billions in fines, criminal charges, reputational destruction. So the big correspondent banks did the math. Serving small banks in risky countries or even risky industries became a liability. The compliance costs were high, the profit margins were low, and the legal exposure was massive. Why take the risk? Better to just cut ties, close accounts, walk away. And that's exactly what they did. Between 2011 and 2020, global correspondent banking relationships dropped by nearly 25%. Thousands of small banks lost access to the international financial system, not because they did anything wrong, not because they were criminals, simply because the big banks decided they weren't worth the risk. The countries hit hardest, small island nations, developing economies, regions already on the margins. But it didn't stop there. Let me give you a real example. In 2016, Somalia's largest money transfer company, a service used by hundreds of thousands of Somali immigrants to send money home to their families, lost its correspondent banking relationship. Overnight, money stopped flowing into one of the world's most fragile economies. Families couldn't receive remittances, businesses couldn't pay for imports, aid organizations couldn't fund operations. The Somali economy didn't collapse, but it came close. And the reason? The correspondent bank determined that Somalia was too risky, too much potential for money laundering, too much regulatory scrutiny. So they flipped the switch. Here's where it gets uncomfortable. These decisions aren't made by governments. They're not voted on. There's no due process. A private bank somewhere in New York or London looks at its risk models, consults its legal team, and decides which countries, which industries, which smaller banks it will no longer serve. And there's no appeal, no alternative, no backup system. If you lose access to correspondent banking, you're out. This doesn't just affect faraway countries. In recent years, cannabis businesses in the US, operating legally under state law, have been cut off from banking entirely. Why? Because cannabis is still illegal federally. Banks fear federal prosecution. So even if a dispensary is licensed, taxed, and following every state rule, most banks refuse to serve them. No checking accounts, no credit cards, no wire transfers. The businesses operate in cash, literally duffel bags of money, which creates its own risks, theft, accounting nightmares, and ironically, more money laundering potential. The system designed to prevent crime ends up forcing legal businesses to operate like criminals. Let's zoom out for a second. The global financial system is built on trust. Banks trust other banks. Transactions flow smoothly because everyone believes the system works, but that trust is increasingly fragile. Correspondent banks are consolidating. A handful of mega banks now control the choke points, and as they de-risk, they're creating financial deserts. Entire regions and industries cut off from the modern economy. This isn't just an inconvenience, it's an existential risk, because when people and businesses can't access banking, they find alternatives. Underground systems, informal networks, cryptocurrencies. Some of those alternatives are fine, some are dangerous, but all of them operate outside the regulated system that governments spent decades building. The irony is brutal. Regulations designed to make the financial system safer are pushing activity into the shadows. Now here's the part that should worry you. Correspondent banking isn't just about small banks in faraway places. It's the invisible infrastructure that underpins everything. If a major correspondent bank were to fail, or if several decided to simultaneously de-risk a region or sector, the effects would cascade, payments would freeze, trade would halt, companies couldn't pay employees, supply chains would fracture. In 2008, the collapse of Lehman Brothers nearly froze the global financial system. But Lehman was one institution. Correspondent banking is the system, and right now, that system is quietly shrinking. Let's talk about what happens in a crisis. Imagine a pandemic, or a war, or a sudden regulatory crackdown down. Correspondent banks, spooked by uncertainty, start cutting ties faster. Entire countries get blacklisted. Payment rails shut down. It's not hypothetical. In 2022, after Russia invaded Ukraine, Western banks severed most correspondent relationships with Russian banks. The Russian economy didn't collapse, but it was suddenly isolated, cut off from the global system. That was a deliberate geopolitical move, a financial weapon. But the infrastructure already existed. The switches were already there. And once you've seen how easily an entire country can be unplugged, you start to wonder, who's next? Here's the uncomfortable math. There are roughly 10,000 banks in the United States. Globally, tens of thousands more. But the number of banks that truly matter, the correspondent banks that process the vast majority of cross-border payments, is probably fewer than 20. 20 institutions controlling the flow of trillions of dollars. 20 institutions that can, at any moment, decide who gets access and who doesn't. No vote, no transparency, just risk models and legal departments. And it's getting worse. As compliance costs rise, more correspondent banks are exiting the business. It's not profitable enough. Too much liability. So the system is consolidating even further. Fewer banks, more power, less redundancy. In engineering, this is called a single point of failure. In finance, it's called Tuesday. Now, some will argue this is fine. The system is self-correcting. Technology will provide alternatives. Blockchain, stablecoins, decentralized finance. These will route around the correspondent banking bottleneck. Maybe. But those alternatives are years away from mainstream adoption, and they come with their own risks. Volatility, fraud, lack of regulation. In the meantime, we're living in a world where the financial system is both more connected and more fragile than ever. More connected because every bank depends on a handful of correspondents. More fragile because if those correspondents pull back, there's no backup. Let me tell you what keeps regulators up at night. It's not a dramatic bank run. It's not a stock market crash. It's a slow, silent withdrawal of correspondent banking relationships that leaves entire regions financially stranded. Because once that happens, money stops moving. And when money stops moving, economies cease. You can't eat money, but you also can't eat without it. Here's the absurdity. We live in an era of instant communication. You can video call someone on the other side of the planet in seconds. Information moves at the speed of light. But moving money, actual money, still depends on century-old correspondent banking relationships that can be severed with a single memo from a compliance officer in New York. The infrastructure of the global economy is held together by handshake agreements between a few dozen banks. And those banks are increasingly deciding the handshake isn't worth it. So what happens next? One scenario. Governments step in. They force correspondent banks to serve certain regions or industries. They create public alternatives, central bank digital currencies that bypass the correspondent system entirely. Another scenario. Nothing changes. The system continues to shrink. Financial deserts spread. More businesses and countries get cut off. Informal systems grow. Or maybe something breaks. A major correspondent bank fails. A regulatory shock hits. The switches flip all at once. And suddenly, everyone discovers that the invisible system they depend on isn't as stable as they thought. Here's what you need to understand. The financial system isn't a machine. It's a network. And networks are only as strong as their weakest link. Right now, that weakest link is getting weaker. Correspondent banks are retreating. Relationships are dissolving. The infrastructure is consolidating into fewer and fewer hands. And at the center of it all is a quiet administrative decision. A switch that can freeze an entire economy. No drama, no warning, just a memo from a risk committee. You probably woke up this morning, checked your bank account, and didn't think twice. That's the goal. That's how the system is supposed to work. But somewhere in a conference room you'll never see, someone is calculating risk, weighing compliance costs, deciding whether your bank, your country, your business is worth the trouble. And if the answer is no, they'll flip a switch. And you won't know until your payment doesn't go through. The global financial system moves $5 trillion a day, all of it flowing through correspondent banks. All of it one decision away from stopping.